before we got on. You said, I mean, you probably don't know anybody who's looking to borrow against their house, right? I said, yes, I do. It's me. And I'm sure other people are wondering if they should do the same also.
It costs money to live on this planet. That's it.
Pay taxes, eat, drink water, and then die.
I look at housing as it is a debt, but it's an investment because in the long term, you're going to make out.
Yeah, if it's an emergency and not just like oh, I want to do this, it's nice to have. Welcome back to another episode of Moving Subs.
Once again, Jen is bringing us into the episode.
I mean, I was just going to wait it out and see who said something first, but you took about a half a second too long.
You were steadfast in your 2-second wait, and you blinked first.
I don't think people know about that. Yeah. If I ever ask Seth for his advice on something, whether it's should I say this? Or what do you think of that? If I don't get an answer back within the first 10, 15 seconds, by the time he actually gets back, maybe a minute later, I said, I already said, I already did it.
Well,
I already said it. Thanks for your input.
Yeah. Well, listen, speaking of input, I am going to provide my input for this topic because it is something I'm having more and more conversations about.
Well, and it's funny because before we got on, you said, I mean, you probably don't know anybody who's looking to borrow against their house, right? I said, yes, I do. It's me.
Yeah.
I am looking to borrow against my house because I have a basement that's not finished. That is the full square footage of my house that is just itching to get finished. And I want to take from my house for that. And I'm sure other people are wondering if they should do the same also.
Yeah. And so I'm going to unpack this a couple of ways, but I'm going to just kind of start with what the perception is of people borrowing against the house. What's wrong?
I was trying to be very stealthy in silencing my watch, and instead I pinged my phone.
Oh, there you go. You should not have that watch, by the way.
Okay, but I'm sorry. And first of all, yes, I should. Curious to know if anybody else feels this way about Apple Watches. Why the ping button looks like a vibrating phone. I always just think that that's the vibrating button for the watch, and it's not. So, and the alarm bell would be like an alarm, like ping, ping, ping. And I mix them up all the time, and that's a really bad thing to mix up because I'm trying to be quiet.
Yeah. Well, and also, but they're very, very distracting. I can't even not look at my phone for more than 2 minutes. So if I had something dinging on my on my wrist, and I just would be even more scattered than I already.
That's a debate for another day.
I digress. Yeah, we could talk about that another day, Jen. So here's the deal. There is borrowing against your house kind of falls into that tranche of financial stewardship, old advice. You're not using your house as a piggy bank. Your house is your rock. That's your nest egg. That's if anything goes wrong, you don't want to do anything with jeopardize that. The other side of it, though, is the fact that
we regularly boast about how having a house is an asset.
Yeah.
I mean, I know that's long-term asset too. But it's kind of similar in a sort of sense to life insurance where it's why wait until you're not really going to need it for yourself to use it when you could use it if you need it. You have it.
Mm-hmm. So a house is a debt until you sell it. It really is because you pay taxes on it. You have mortgage on it. You have insurance on it. You have to upkeep it. The idea of home ownership, though, is it's a long-term play because
tell all the people more reasons why having a house is just so lucrative.
No, but in the end, it's a hedge. It costs money to live on this planet. That's it.
Doesn't that suck?
It
on this planet to just pay taxes, eat, drink water, and then die.
We, as humans, decided to create the monetary system, which has created an enormous expansion of prosperity and goods and services. Unfortunately, the prosperity and goods and services cost money, and housing is one of them. It's one of the 6 pillars of life. It's shelter. It costs money. So there are a lot of talking heads out there that say, hey, a house is just a debt. It's not an asset. It's not an asset. And technically they're right.
Yeah.
But it is an appreciating investment. And it
Not
is
like
also
a car. You look at it like if you have a house and you have a car, I mean, yes, they both cost money. Yes, you have loans on both of them. However, as soon as you drive off of a lot, you're never going to get back what you paid for it.
No.
Ever.
No, it's a depreciating asset. It's a depreciating expense. And so, yes, the more miles, the more wear and tear, it costs money to upkeep, whatever.
But you don't get something back for that.
The thing that's great about housing is that it's like panic proof. Like this whole thing, like 2 months ago with the tariffs and like everything went down, 10+%. Housing just stayed the same because it's just too slow. It can't react the way that a stock can. You can't have a bunch of people in Wall Street just selling things off or insider trading or anything like that. It's just too slow. But the other side of it is that I look at housing as it is a debt, but it's an investment because in the long term you're going to make out, usually in a normal market where prices go up 2-3% a year, and the long arc of owning it for 7+ years, you really
we're so in normal times.
Yeah, I know. Well, yeah, what are normal times? But
I don't remember.
In terms of the historical context of how owning a house, it is not even close between owning a home and renting. You just literally renting, you're just flushing money down the toilet. You have nothing to show for it at the end. Yes, it gives you some flexibility. Yes, you don't have to fix the roof when it leaks, but in the end, we've talked about this multiple times on a podcast that you get locked in at a point in time, and then basically other people buying houses around you is what makes you money. So and also when you pay the mortgage down, you're paying off a debt, and then at the time of settlement or the time of sale, you get the paid off. You get the equity, which is the amount that you actually own of the house, versus the mortgage. But the thing is that there are people out there who have, because we've gone through this large ramp up in home prices, there are people sitting on hundreds of thousands of dollars potentially of equity, of money that let's say like Bob and Susie Smith have $500,000 in equity. They go to sell the house. They would get, after fees and everything, they would get that money. The idea of borrowing against your house is you go to a bank, you still have your mortgage, but you go to a bank and you say, hey, that chunk that I own of the house called equity, can I get access to that? There are two ways to do it. And I'm going to talk about that because I believe that in the next 2-3 years, this is going to become, in the next year or so, it is. And then definitely in 2-3 years, if people continue not to move, they are going to start tapping that for various reasons. One is the worst reason is you lose your job, you run out of money, you don't know, you run up your debts, whatever. But there's also people who want to improve their home. They want to just have a nest egg. They want to just have access to the money in their home in case something happens. So there are two different ways, and there's two different purposes for these financial instruments. One is called a cash out refi. Okay. So a cash out refi is you go to a bank and you say, listen, I want to refinance my loan. So what that would mean is that you would go and at today's rates, you would go and wipe out your existing mortgage at today's rates. And then you would take the equity and you would just borrow that. So they'll let you borrow up to 80%. Simple example. Let's say you have $1 million house and you have $500,000 you still owe on the house. That $500,000 is your equity. The bank will let you borrow up to 80% of it and access that. They'll never let you borrow the entire value of the house because it needs to be, the bank doesn't, if in the event that home values fall, they want to make sure that they can still, they're not underwater, but they will let you refinance that amount. So what that means is that if you have $1 million house, you have $500,000 of mortgage that you owe still, and you have $500,000 of equity. that would basically bring it down to $900,000 that you would be able to refinance and reborrow with a new loan. Doesn't have to be the same bank, anything. And then you would get a new monthly payment. But the thing is that between the 500 and the 900,000, that 400,000, that's cash you'd be able to pull out. That's just straight cash. You don't have to pay an interest rate on it or anything like that. But you have a much higher interest rate or a much higher.
I have a feeling that's not necessarily the route that many would take right now, considering a lot of people already went through refinance in about 2021, 2022, and are sitting on some pretty 2% and 3% interest rates that don't think even having all that cash handy would be able to alleviate the fact that they would then lose that current interest rate.
That's right. And so cash out refinance would be something I would argue.
That was something that was a preferable option though before all of this.
Yeah. Well, yeah. I mean, people, I mean, I know people who bought a house in 1996 and they owe twice as much as that they even bought the house for. They literally just use their house as a piggy bank because they're like, if I could take my money out and put it in the market and make more than my interest rate, then it makes sense. Or like my house is not going to be part of my retirement plan. It is simply a vehicle, a place that I can just be, and I'm going to have other investments and be able to engage the marketplace in different ways to make my money for retirement. I mean, there are people with that philosophy. So there's not a lot, but there are people out there who will do that. The reason that people do cash out refinances is usually they're in some kind of financial distress.
Right.
Or they are just going to use their whole house as a piggy bank to pay for college, or they've or they want to start a business, but they want access to that cash and they feel that they can float a new payment. Now, in this day and age, it's a little harder to your point, because you've got these like 2.5%, 3% interest rates jumping up to a 6.5% rate. That's just a different monthly payment. It might not be as equitable given that dynamic. But that money you get out, that cash out refi, you do not have to pay any interest on it. It's just like literally you get your cash out.
That's a benefit. But
that's the benefit.
I mean, while you don't have to pay an interest rate on it,
you kind of are.
You are, because it's just it.
Yeah.
And if your rate is, I don't know anybody who's going to have higher rates unless your current rate is higher than what the current rates are, unless your rate would be coming down because of the cash out refi.
Yeah. Or they're like kind of stable. They're someone who bought a house.
Right. Like that. Well, then they wouldn't have enough unless they put a fat amount down.
No, but I mean, if they put like 20% down and they bought in 2021 and it's been 4 years, their appreciation, like all that money,
they bought in 2021, they have like a 2% and like a 3% interest rate.
Yeah, but again, if they need the money, they can get it.
Right.
And it can make sense in certain situations.
But not in the sense of, not by the perk of saying that you don't have to pay an interest rate on it, because you do. Just it doesn't.
It's just different.
It's somewhere else.
Yeah.
It's on something else.
So let me go to a home equity line of credit, because I think that's the more favorable situation right now.
And that's the one that's been flying out of my mouth left and right for the past like 2 years.
Yeah, because it's a different thing. It is so misunderstood. People don't get it. And
it's kind of complicated to understand.
It's actually not.
But when somebody's like, if you're speaking in it, that's why we have this podcast, so that we can make it easily digestible. Because when I was first learning about HELOCs, like, even first of all, they didn't go through this in real estate school.
No.
We had to go through all of, like all different types of loans and balloons and bridges and all this other stuff that we were then also told, by the way, you can't give guidance on this because you're not blah, 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 blah. But like, they don't go into a home equity line of credit, which is actually the one that is more relatable to our job specifically, as we are guiding people. But like, even when I was first really learning how it worked, I was a little confused.
Yeah. Yeah. And I talk to financially savvy people and they don't know about it either. So I actually have a home equity line of credit. It's commonly called a HELOC. And what that is, you take $1 million house, you have $500,000 of a mortgage, and then you have $500,000 of equity. A HELOC leaves your existing loan to its own thing. It doesn't touch it. So you get to keep your rate, but the bank will let you access that money and give it to you in a whole other like line of credit. It's like a piggy bank. The difference between that and a cash out refi is that when you draw that money, you pay interest on, and it's called prime. Some credit unions, community banks, some will say you pay prime. So prime right now is like 8%. Sometimes prime +1. They'll give terms no 0%, or for the first 60 days. Here's the nice part about it, though, is that the cash out refi, when you do that whole refinance action, there's costs associated with it. You got to repull title and do all that. It is immediate. Like your interest rate and the effect of it completely, it takes effect once you sign the paperwork. A home equity line of credit, you can draw that money and not spend it. And you don't pay any interest on it until you draw it. And if you do draw it, you only pay interest on the amount that you pull. So if you have a $250,000 home equity line of credit and you pull $10,000 out, you only pay interest on that $10,000, not the $250,000. So people hear like, oh my God, 8%, that's robbery. It's like, yeah, but like only if you draw the entire thing or a huge chunk of it. They last for 20 years. You don't have to draw them. And they are a great tool to offset.
Well, you can choose how long they last, and that also determines what the interest rate would be.
Well, but generally they'll expire. They'll expire for 20 years. They won't let you hold it for 20 years. So more than 20 years. But the thing that's nice, you don't have to draw it. So then we're like,
so if you decide I want to sell my house and you have this line of credit out,
yeah,
okay, you still have that.
Yeah, and like a home equity line of credit can be used for repairs. It can be used to offset any kind of interruption in your job. It can be used to finance college. It can be used to just be your emergency fund. Like I have a home equity line of credit on my house. I don't touch it. I've gone through a couple things in the past couple of months that you know about that are like, I was really happy that I had it. I didn't need to use it, but knowing that it was there and I have access to cash that I can use, like tangible, because here's the thing, Jen. People are like, I have like all this equity in my house. And I'm like, but do you? Like, do you actually have access to it? Like, who gives a shit if it's just if it's a number on a sheet? Like, okay, maybe that goes into a mix when you're talking to your financial planner, and yeah, that'll be, but most people don't actually have access to their equity until they sell. So these two things we're talking about are ways to access it.
That's what I was saying at the beginning. Is like, why wait until you sell, if you sell, to be able to access this benefit that you have by owning it?
The reason that you would not do it is if you are not financially disciplined. And that's going to be my final point.
Well, that's a fair point.
Is that people will take it out and then they run it up. And then they are like, well, honey, we have this money, so we should just use that. Forget about the credit card. We shouldn't put it on the credit card because like we have this, that's 27%. We should just use the home equity line of credit. People, like I always say, if everyone did what they were supposed to do financially, the entire economy would collapse. I mean, it's built on irrational decisions. So there's a fear, and I think a lot of parents probably put this in their kids' minds, and they've been doing it for decades. So it's
what would you say to somebody who says, well, forget putting it on the credit card. Why not use this because it has a lower interest rate?
I would ask for how long do you think it's going to be until you pay? Like I would ask for what their credit was and like, do they carry a balance on their credit card? Because I would be like, well, if you carry a balance on your credit card and you have this home equity line of credit, like you really should just be using the HELOC to pay off the credit card.
Right. I mean, that would
27 to an 8%.
Right. That's what makes sense to me. I mean, if you're going to take a HELOC and say like, oh, what are the credit, just pay the credit card off.
Yeah, but people were, man, people are weird about money. And like, so when I talk to people about like whether they should do this, like I don't go to every Tom, Dick, and Harry about this. Like I don't go to people who I know they're either like really kind of struggled to get into a house, or that they are, they're just not like the best with money. But it's a really great strategy to just get in, just have access to that cash, because that can be your emergency fund. Like if you go with a financial planner, and this is not financial advice, I'm not a financial planner, but a financial planner is always going to say you need an emergency fund. You need like a base fund. Like if all hell breaks loose, you lose your job, something major comes up, major medical expense, car dies, whatever, you need that emergency fund in order so you don't go into debt in order to handle that emergency. Some financial planners will say you should just do the home equity line of credit, have access to the cash, but then that is your emergency fund. Because in the event of an emergency, like 8%, and like, let's say you don't draw the whole thing, but like you need an extra 10 grand in a hurry, that's a hell of a lot better than going and charging to a credit card. Mm-hmm. So that's my philosophy, is that my emergency fund is this home equity line of credit, which is very substantial. And like, if I'm dealing with some major life event, like I don't give a shit about interest rate. Like but now I get all my extra cash.
That's the thing. It's because like, we're talking about, it's really great to be able to get this access to this money, but like the interest rate is a total factor. And that's kind of like, as somebody who'd gone through this and was looking to actively pull on it for a project, I looked at it and I was like, whoa, yeah, look at that. Look at that rate. Look at that payment. Because it's like, 8% on a loan that is essentially on something that's getting charged for a shorter duration of time makes it could come a little higher, and it's a little scary to look at. But if it's an emergency and not just like I want to do this, it's nice to have.
Yeah, but also like, an emergency isn't just like a life emergency. Your HVAC dies.
That's an emergency.
Yeah, that's an emergency.
An emergent issue.
Emerging issue. Your roof is shot. A lot of people bought houses and
cross your fingers and hope there was a storm recently.
No, there's a lot of people who built a house in 2012, 2013, 2015, and
it's getting
30-year shingle they're all gone. They're all gone. They're done, and it's actually a 12-year roof, and you need a new roof, and you weren't expecting it, but something happened. So it is only, I would say, the home equity line of credit, I would say, is only for the financially disciplined people, and it's not for somebody who just wants to use their house as a piggy bank. And because the 8% interest rate, like, that's real, but I would argue
when I was looking.
I know. And I mean, it's not a small amount of money, but I love the idea of having that as my emergency fund. And then I can use all my other cash to put into investments and give it to my financial planner, or use it for vacations or whatever. And I think it's a worthy thing to look at. And you can go to like a credit union, community bank. You can go back to like your bank, but usually like smaller entities give really great terms on it. You'll have to pay for an appraisal, but it's nothing. It's less than $1,000 to get a home equity line of credit versus a cash out.
And for the appraisal for that, I'm pretty sure they automate that that they do an automated one. At most, they go outside. Nobody comes in the house.
Yeah. And it's like, and because all they really care about, and I tell my clients all the time, like, believe it or not, appraisal when you're buying a house isn't actually figure out the value of the house. And they're like, well, what do you mean? I'm like, it is literally the bank just making sure that they're not making a dumb loan, and that the price is enough where they can lend, and that if for any reason you stop paying, that they can take the house back and sell it and not lose money. Like, that's really all it is. So, you go and you run up against a homeowner who has gotten a private appraisal. I always kind of just am like, ugh, because when you bring in a private appraiser, the function of it is different.
I just explained this to somebody 2 weeks ago.
Yeah, and when you told me that, I was like,
and so did I.
Yeah, I was like, I got tagged with that in King of Prussia, man, and he had it, and he was stuck on it. And he's like, "Well, that's the appraiser's opinion." I was like, "I get it, man." But I was like, "I got 7 comps here, is telling you like this is what your house is worth." Thing sat for 4 months. It's the only house, one of the only houses in 2022 I didn't sell like quickly.
Well, to be fair with this person that I was talking to, it was they had said that they were now like somebody's just like, oh well, like you could get an appraisal on it first, and I was like, and my word vomit that just came out, a knee-jerk reaction was, oh, don't do that. And it's like, well, why? And I'm like, well, if you think about it, like, you know, when somebody comes out to appraise the house at first, you know, they're starting at not nothing, but you know, they don't have a number to reach. I was like, meanwhile, when you're under contract and you're under a contract price, appraisers see what you're under contract for, which I have my own opinions on, but that aside. But they have something they're trying to reach towards and say like, okay, well, like I gotta hit this. Let's try to get to this number. I was like, and without that, then, you know, it may not serve you as well. And then come to find out she had already gotten an appraisal. Now, and with what it came back at, it may help them, but it's still.
Yeah, it's just a different function. So financing appraisals and like home value appraisals are different. So, but no, I think we can leave it there. But I would just say that if you feel that you are good with money, that you will not be tempted to bring, to use it or use it recklessly. It can be an amazing tool to help you offset the cost of home ownership, and also just let you sleep at night knowing you actually have access to your equity. Like you don't, it's not stuck in, and also like, you know, kind of, there's parts of the country where people go to home equity lines of credit and like, they're damn happy they did because their house is worth 20% less than when that was issued. Now, if they do that, they draw that, and then their mortgage, like, and their house value is falling, you know, they run into a chance of being underwater.
Right.
But,
because then when you go to sell and you've already used the equity.
Yeah.
Okay, if you don't use the equity though, because you
exactly
have it.
Yeah, but
you've already used it and you're in an area of the country that is having home prices fall.
Yeah, but also the reason home prices are falling, usually there's other things that are going on. There's more job loss. There's more uncertainty in the market. And that is one thing I am telling people about these home equity lines of credit. Like if you're in an industry, man, like even in Philly, like if you're in an industry that has where you're like not sure about jobs, like pharma right now, tech, there's a lot of uncertainty in those industries. Like you really should just grab all the equity at your house just in case, you know. And I'm in a situation where, you know, my wife's job just like kind of just switched up, but we're fortunate enough to not have to like, you know, panic when something like that happens. It all ended up working out, but there are people who would just get flat out laid off and not have any money.
And it's just good to even know that there are options and to be able to explore them and know what's best for you.
Yeah.
Maybe you did get. So actually, never mind. I can't think of anybody who would serve better with a cash out refi right now. not right now.
The cash out refi is, and we did not talk about this at all, and we don't have to get into it. But a cash out refi is also really great for investors if they can make the numbers work, because what they do, it's called the BRRRR strategy, where they buy it, and then they basically buy it for cash, and then they renovate it, and then they refinance it and pull the money out, and then they go get their other property. So that's like how like the plumber who's 65 has like 14 properties, and you're like, how the hell did he buy 14 properties? It's that way.
Well, we've talked for a while about doing an episode on that, and we will, but that makes sense because they buy it. Well, yeah, they're buying it with cash and then refi. Like they're not up against an interest rate they already have.
That's right. The contrast there is the
average person who is the average homeowner who's not doing investing, like real estate investing. Like even if they bought, because like by the time you would gain the equity in it by, you know, the natural progression of time, not by what you put down, not enough time has elapsed yet for those who have a higher interest rate.
The issue though for investors is that they don't have that contrast with the rates, but what they do have is to consider whether the payment that they would have by pulling all the equity or pulling all the money out isn't going to be covered by the rent.
Right.
Like if their monthly payment then, so you have a $500,000 rental, you pull all the money out and then you have a payment now because you bought it cash, but now you have a payment. Is the rent that tenant is paying enough to cover that payment? Because then it's like, well, then it doesn't make any sense. So sometimes they'll pull like 50% out, or they'll just bring it down so they feel comfortable with the difference between the rental payment and the mortgage payment. It's just like a different financial computation. Okay, but cash out refis would be absolutely more leaning towards the investment side than Bob and Sally Smith, residential homeowner with a 2.5-3% rate.
Right.
So it's different strokes for different folks, but we're obviously happy to talk to anybody who wants to go through this process. I am actually a mortgage loan officer, although I probably
you can give financial advice because you are
not like financial planning advice, but yeah, I can give lending advice, but I would probably still I'm a lender at like a large national, like 11th largest lender in the country. Like I'd probably still steer you towards a credit union or like a community bank because they can like manually underwrite it.
Well, Megan Henley, who was on our podcast, she's like, oh, I have somebody. She's like, I send her hundreds of HELOCs.
Yes.
Who is excellent.
Yeah, mortgage brokers can do it, but usually the terms aren't as favorable, and there's not a lot of money in it for the lending officer. And also, if you're in if you're a 1099 or you're a business owner, like you almost want that like small bank to like kind of manually underwrite and like really look at it, because a lot of banks will just throw it away if it doesn't fall within their criteria. So, but yeah, anybody
HELOC to a Bob and Sally Smith who want to start investing into real estate?
I'm sorry?
Would you advise a HELOC to a Bob and Sally Smith who want to invest in real estate?
Yeah, I would, as long as the numbers make sense and what they're going after will actually cash flow after acquisition. So, if somebody's in $1 million house, they want to pull $350,000 to $400,000 out of their house, which is about all they would be able to do if they've got, if the $500,000 mortgage, and then they have $500,000 of equity, the pilot should pull about $350,000, $375,000 out. You're going to be drilled down to some pretty low price points. But yeah, it can make sense. Right now, though, rents have not kept up with the price of homes, so it's really hard to buy and hold. Because by the time you get in and you finance 75% of a house and you put 25% down.
I know, for anybody who's listening that is a renter and frustrated with the rental market too, because rents are so high, the cost to get them is also high right now too. So shoot, I haven't. Yes, I have. I'm lying. I've sold rent properties intended for rentals, but they're duplexes, not like individual homes.
Yeah, that'll be though. So in a faltering economy though, landlords will liquidate. That's how pricing goes down.
Which is another really good reason to try to find out if you are able to buy, because you said at the very, very beginning that, rentals have the perk of flexibility, but not stability, because your landlord decides, yoink, your lease is good through the lease term, but as soon as it's up, you're screwed.
Yeah.
Could be.
That's a real thing. You
have a landlord who, transfers it, and you have another landlord who's happy with it being there. But most of the time, if your current landlord was cutting you a break on rent and you know that you're paying under market rents and somebody buys that place, your rent's either going up or you're out. That's
if they even want you there. They might, if your files
are renovate.
They can just give you your 60-day notice. They'd absorb the lease. They'd get the lease and take it over, and they would give you your 60-day notice, and that would be it.
It's
so that is another thing. In a faltering economy, people have to understand that as a renter, you might not have all the stability you think. That flexibility can work both ways. That landlord has flexibility to just sell that thing off because he doesn't live there.
Mm-hmm.
So people,
it's a literal asset for him. It's an income producing object
yeah,
to them.
and
Your home, but it's their asset.
That's right, and people are just going to as money slows, and that's what a faltering economy would be. People want access to cash, and there's usually these rentals. There's a big bucket of cash waiting for them. So and I've dealt with at least half dozen landlords who sold, and they're like, yeah, I'm literally selling this, and I'm going to pay the capital gain on it, and I'm going to put my kid through college with it. He's like, my wife and I bought this 15, 20 years ago, and that was the only purpose. It was just to cash flow it, save money, take advantage of the appreciation, all the tax benefits. And then that's like, they just take that house and they put it towards the university, and that's it. And they don't have to touch any of their other assets. They haven't been saving for it. They haven't been putting money aside. So there's a lot of reasons to that would happen. But also, that landlord loses his job, he's going to sell that property. His wife.
Yeah, sell that one before he sells his own.
Absolutely. So, okay, well, that sounds good. I wanted to go over that. If anybody has any questions about borrowing against your house, it was very case specific, but I and Jen can walk you guys through it. And
anybody's curious to see if I actually go through with doing it myself. I don't think anybody understands the pain that I'm in to get my damn basement finished, and this. See, it'll be a faster track to getting it. So stay tuned for that one.
I had it and I just never used it, but I'm really happy it's there. So and I actually just before we go, like, I got one in 2022, and then I literally for $90 at my credit union just recast it, and they said, oh, here's more money. It's like, it costs nothing.
You did what?
So in 2021, I got a HELOC for a certain amount. In 2022, I got a HELOC so I have my existing mortgage, and then I pulled and I have a HELOC issued for a set amount. I then last year went back to the same credit union and I said, listen, I want to my house is increased in value. I want to expand my home equity line of credit. I want you to fund that home equity line of credit to a higher level. So it went from this amount to this amount for like $90, because they had already. I mean, all I had to do was resubmit my docs, and my income was stable, everything was the same, and the value of the house. So yeah, they're like, banks want to lend, so they hope I spend.
Mention too that I think is actually important to know too about HELOCs. I probably should mention in the middle of this episode, not at the very end, but correct me if I'm wrong, but aren't the interest rates on HELOCs floating and not fixed?
Oh, that's a great point. We totally forgot to say that. Yes, they are variable. So when I got my first HELOC, they were at 4.25%, and now they're at 8%. They do follow. I don't think they follow directly the 10-year Treasury, but they closely align. So yeah, like, if interest rates go down, in fact, I should see what my home equity line of credit statement says and see what it is. It was at like 8 for a really long time, but that's when like rates were at like 7 and 7.25, 7.5. Now rates are more like 6.825. So yes, but they float, and they float in real time. So you like borrow $50,000 out of your home equity line of credit, like every month it can vary.
Up or down.
Up or down. Yeah.
Right.
So that's a great point. I forgot to say that. So yeah, it's like a totally different.
Maybe we just cut that part that we just said and we stick it in the middle of the episode during.
People listen to the entire episode, Jen. It's
Brian Cannon does. Hi, Cannon family.
Hi,
Hi, Jack.
Hi, Ross. Hi, Jen. So, all right. Well, we'll leave it at that. And yeah, it's a good topic. Anyone needs any help, that's what we're here for.
Okay. Until next time.
Bye.